Hi, everyone. Welcome back to yet another show of Reinventing Finance. As usual, I'm not by myself or alone. I have my lovely co-host Tom with me today and this fine morning. Tom, how are you?
Thank you, Nick. I'm very fine. Looking forward to our conversation.
A smile on his face. That's all it takes. We're also not just talking by ourselves in our little InsurTech echo chamber. We have Cenk with us from Lumnion. Cenk, how are you this fine morning?
Great. I'm very happy to be here and talking with you guys. So it's
awesome. And we're very,
wonderful.
This is an international and a truly European platform. So dialing in from Istanbul, Hamburg, and Zurich, which I think is a pretty good, pretty sweet European triangle. Cenk, before we get started, why don't you briefly introduce yourself and your company so people can kind of put you in their right box and then also let you out of it again?
Okay. I'm Cenk. I'm the CEO of Lumnion. I come from a pretty long corporate background, initially starting in banking, risk management, and then retail banking and some wealth management side. But more recently, before finding Lumnion, and we'll get into what we do, I was managing a mid-sized insurance company as the CEO myself. So we gone through the pain of all the things that we're going to be talking today. Hence, we tried to develop solutions to those pain points in the industry. And coming to what Lumnion does is Lumnion develops state-of-the-art AI-based pricing platforms for property and casualty and health area of insurance. Basically, we use machine learning extensively. And as I said, our platform is trying to solve the pain points in the industry. It's an end-to-end platform that can start from preparing the data. It can actually fetch data by itself, and then all the way to giving prices to the street level. So this is, in a nutshell, what Lumnion does.
Awesome. So maybe I would say I've created my fair share of insurance product, or been part of that. Probably 100 and counting. Having said that, that magical pricing, the underwriting, to me was just always something where I've either gotten a simple or rather complex Excel spreadsheet with lots and lots of numbers and sometimes formulas, sometimes just spreadsheets and people saying and wondering why the calculations don't quite add up. But that's more on for a different story. Or some API. So maybe you could illuminate us on how does that normal process of, and pick a simple or complex example that elaborates some of the pain points on how to get towards pricing, what that process normally looks like, how laborious it is, and which pain points you identify, and then it should be an easy segue into a sales pitch.
Yeah, we see various maturity levels in different companies, obviously, and one is that exactly what you described is using Excels and trying to get something out of it, which is not the ideal case, but we see the usage. Also, there are some tools that you can run your risk models, but they're only good for certain algorithms. For example, GLM, which has been in the use for the last, couple of decades. It's not a...
What does GLM stand for?
Generalized linear models. It's
okay.
An algorithm, basically. It's a linear regression algorithm. It's been widely used in insurance, property and casualty area. It's not bad, but obviously with a lot of technological developments in the world, there are these machine learning concepts, machine learning algorithms, which can predict losses much better and can also take your risk pricing in a more precise level, okay? But companies shy away from using these because they're kind of black box, and insurance transparency is really, really important because you want to see what's going on in your pricing process, obviously. In black box algorithms, it gives you one price. You see from statistical results that it's pretty precise and it works well, but still, for various reasons, we can set some examples also, you want to really understand what's going on. The actuaries wanted to see that. But let's just take a step back and what's happening today. Initially, obviously, for modeling risk, normally modeling works for products where there's a lot of data. For example, retail products, household insurance, health, casco, motor own damage, mandatory traffic products, okay? How it is done is you basically get mostly 5 years of historical data with claims and also with the policies and try to put it together in one data set and then run your algorithms in it. Putting it even in the same format for data to be processed by the models is a very cumbersome process. Most of the time, this is done manually with the help of IT in many companies. It can really take 3 to 6 months. So there's no automation. Once you get that data, okay, you run your Excel model, which is not ideal, or you can run your GLM model, which is also not very ideal at today's advancements on machine learning and AI. So you run your model, and then obviously you get the risk pricing for your products and for certain segments in your portfolio. But there is also a lot of competition, and there is a commercial side of things. So you cannot obviously take your risk price and put it into the market. You are not alone in the market. You need to monitor what's happening. You need to load your commissions, your sales channel costs, any other inflation. We'll talk about it. I think that's a very important factor these days. So you need to load these to come up to your commercial price depending on your strategy as well. Is it you're going for market share, you're going for profitability? I mean, what's your strategy? Once you determine your commercial price, then now you need to take it to street because you have various channels. And it's an omni-channel world these days. You know, one thing can start in a digital channel, end up in a traditional channel, or vice versa. So you need very modern tools for portfolio management, which can really identify what's happening on a day-to-day basis in your commercial portfolio, commercial life, and then take these prices to street level instantly. So this becomes a whole new way of doing things, which is kind of inevitable in today's world. If I'm able to explain it, that would be my answer.
Okay, so effectively and let's talk about those where you kind of have a proper actuarial model rather than more of a kind of underwriting approach. You know, we're not talking, super large commercial risk, but maybe we are, I don't know. But you have a large amount of, let's say, data around individual risks, whatever that is, right? If you take 5 years of data, we get some excerpt from our claims data, probably needs some cleaning up. We take some policy data. Then these need to be clean and matched so you can run your regression analysis, with different multi-variances. I don't exactly know how. It has been a while since I've done this at uni. And out of it, you'll get your respective risk premiums. And these are then usually provided by the actuaries, and then, something else happens, right? And what you're saying is this has a few problems. Number one, it is quite cumbersome of mapping and cleaning up the data sets. And it's probably not an intern's job, but, very expensive actuaries or data scientists who just need to do the cleanup. You then have a challenge around these models, because they're inward looking, ignore factors to get towards a commercial price, because you're absolutely right. Commission levels, hugely variable. Competitive pressures are variable. You should probably have a view about your current portfolio, because that's kind of implicit. So that I would say that is included. But inflation, competitive pressures, and you're absolutely right. What's your strategy? Market share, profitability, etc. And then what you're also stating, one problem is that this is a, let's say, recurring, but more like project-based approach, because it takes 3 months. You maybe do this every 2, 3, 4 years only. And you don't have any real-time data around your actual claims. And for example, raging inflation, makes a problem. You already see the claims, and then you have this really elaborate process, and then you just go, okay, let's just get 15% up on everything, because that's the only way you can approach this. Is that a fair summary of?
Yeah, just one additional thing. Obviously, this has various, how should I say, stages of doing things. First, the data preparation, then the risk modeling. On the risk modeling side, as I said, everyone wants to use the new machine learning algorithms. But for them to be operationally usable, because they predict losses better, you need transparency. So what Lumnion does also is, on top of all the things that I explained, we make any of these machine learning algorithms transparent. Basically, they become instantly operationally usable by the actuaries. So on the risk pricing side, now you're able to get much more precise results seeing into the machine learning algorithms, which are normally a black box thing, okay? So this is very important because it just opens a whole new window in front of the actuaries that they can do things a bit differently. But then, as you correctly said, real-time data and how you run your analytics on real-time data and take your commercial decisions is a very important determining factor in today's world, because things are changing very fast. Think of it, like this started in approximately like three years. Before, things were much easier. You could run your models every 2 years, 3 years. Nothing would change that much. But then we have seen pandemic. It changed a lot of things. But a lot of companies continued to run their historical models as if things didn't change, and they got their hands burned. Only after things happened, they realized what happened. So today's world, you really need to be agile. You really need to know what's happening on a day-to-day basis. And for that, you really need machine learning on a portfolio management level to identify certain things to you and tell it to you. For example, maybe as we speak, in one of the portfolios, certain car brands by certain drivers, a micro segment that we can define, are having a lot of accidents, or they are being stolen more than ever before for various reasons.
Sure.
Or because of inflation, for certain car parts, car brands, now things are really changing a bit. Also, the cars are changing, okay? It's not the car that 5 years ago. Cars are today mostly electric, and now they're electronic devices rather than cars. So the fixing of those are a very different story than what you were doing a couple of years ago. So you really need a state-of-the-art tools to identify what's happening and need to take corrective actions. Today, machine learning and the platforms like ours can tell you what's happening in your portfolio in a micro segment level, so that you can really take actions and correct your behavior. So things are really changing. So you better leave the Excel on the side, or all the algorithms and all way of doing things, and really move to some new tools.
I think just for those of you listening, that the black box problem with machine learning, and the transparency. So, for example, in most, I believe, EU countries, you are not allowed to discriminate against certain gender. You can discriminate, I think, by income, but not by race, by religion, etc. And whether it's vogue or not, unfortunately, these are they're correlations. They're not causality, but they're correlations that, women are better driver than men, all things considered. And I believe there are, you can go from certain ethnic backgrounds, and it's a high correlation with certain socioeconomic factors that then again drive certain risk behavior. It's not nice to say those things, and it's not politically correct. And I think therefore, there are, and rightly so, something considered in insurance, you want to counteract redlining, because insurance is not just to insure the healthy, which otherwise, there is a social good towards it, because, you balance good and bad risks. And so it's very important that an ML algorithm will find these things out. And so if you don't really know where it came from, because that's the beauty of ML, right? You do not have to, it's not hypothesis driven, it's implicit. That's the beauty, because then hypothesis driven, you could run regressions. Now, out of interest, how does that work? So you go in, and do you kind of run two models or something? You run an ML model, and then you don't have to spill your secret sauce, but I think
No. I mean,
you'll have to elaborate how that works, because implicit is one of the benefits of ML, that it finds signals that are too complex for humans on a hypothesis-driven way to interact. Correct?
Correct. First of all, what you describe about insurance is very right. So unless you are able to make these machine learning algorithms transparent and see into those, you cannot avoid discrimination, because by nature, machine learning algorithms, they're not human. Huh? They don't, they may be discriminating any gender, any segment, any socioeconomic class, if it's seen as a bad risk somehow in the algorithm. So, okay. But obviously there are regulations. You don't want to burn your hands, and you want to know what's happening. So there you need transparency. To get the transparency, what we do is we have developed our own methodology to open up into these algorithms. And at the back end, I'm not going to obviously explain all the process behind it, but the system kind of tries every possible combination of interactions and variables, and then will kind of open this algorithm, the black box, up into a linear algorithm that can go into various dimensions, up to 6, 7, 8, how much you choose to see it. In a human eye, or in a generalized linear model, you can probably start to get confused after the third interaction, third dimension. But the machine obviously doesn't get confused, and it can go to 6, 7, 8, 9. So in a way, we can define a very small micro segment as such. For example, male drivers between the age of 25 to 30 driving red Toyota Corollas in a suburb of Munich, which have blue eyes. Okay, I kind of gave you like 8, 9 dimension, a micro segment. So you don't have to right away say that, oh, red Corollas driven in this suburb of Munich are bad. No, not necessarily. So you're actually mispricing everything. And you have to open this up. You have to see it. Unless you see it, you cannot use it operationally. So in a way, we developed this whole methodology. It's our kind of trademark, secret sauce, as you say it. And we are able to show the actuaries what's really happening behind the scenes.
So and I have to say, I did statistics for dummies at uni. Okay, I was really glad that you could do, I think, statistics for management studies. It was really basic, right? Regression was press a button on Excel. So please bear with me. But so you basically run the ML with the various different methodologies, and that gives you certain prices, but you don't know any causality, right? Because that's not what it is. Right. And then you almost like I don't know whether back testing is right, with linear algorithms, like with a lot, who then would give you a similar causality, which you can then present and validate and say, right, listen, this was sexist. We can't, it's unless you're in Switzerland, where you can discriminate based on gender.
Well,
this is I'm pretty sure you can. They're not in the EU, so then you cannot do this. And there might be in the United States, it's even you have admitted, non-admitted. You can't even do dynamic pricing, which you might use for aggregator driven. So I think it's really interesting that you need to. And it's really timely as well, right? You need to balance the regulatory requirements with the technology feasibility, and kind of put a layer on top that kind of connects these things rather than just having them run wild. Understood.
100%, right on spot. It's just, it's kind of reverse engineering, as you described. And by the way, it obviously loses a bit of a preciseness from the original black box machine learning model, because that's inevitable, but it will still outperform your traditional models like GLM. So obviously, and from that point on, actuaries will have a couple of options. They can use their traditional GLM if they like it. And by the way, when we run GLM, we also use machine learning at the back end. So it tells you which variables to use even in your GLM. Or you can use the machine learning model, black box one, if you dare. I mean, we don't advise to do anything. We just make all these usable.
And you don't call them out in public either.
Yeah. Or you can use this transparent version of the machine learning. Now you can see into it, okay? It will give you these interactions into various dimensions, 7, 8, 9. You can take those interactions and define it in your original GLM and bring it ever closer to machine learning models. So now the actuaries will have a lot of options, and they can use this as a playground.
So you've mentioned, understood, and you've mentioned inflation, and it's it's pretty rampant across most geographies. So and the problem, from my personal understanding, is that inflation ultimately significantly drives up the cost of claims, repair, etc., and potentially also the claims frequency if you would argue that certain socioeconomic situations might align people more to figure out whether they I'm not even talking about fraud, even though that can also be an angle, but also to kind of just look at, I'm actually now going to sit down and bother with this insurance claim, which I might not have done otherwise, right? Especially, I believe, on the kind of lower frequency stuff. So how does your system help versus, well, let's just increase prices by 15%?
Yeah, you could do that, obviously, but you may lose some money doing that because you're not sure whether the competition will do the same. So, I mean, it's very important that you have a tool capable of actually running different scenarios, and you will have different inflations in different areas. It's not just one inflation, okay? Inflation in a car that is produced in Japan for its spare parts may be a different increase rate than your workmanship in Germany, okay? So very different components of inflation. You have to be able to define those precisely and then simulate and run various scenarios to see what happens at different levels, okay? And then you also need to monitor what is happening also on street level or reality on a day-to-day basis with the real-time claims coming in, real-time policies being written, and you need to really then take very smart and knowledgeable decisions with the help of the tool. So this is how we do it, okay? We simulate, run scenario analysis, and see what is happening, what can happen in your portfolio in certain situations, and also show side by side what is really happening today. And you can use these analytics power and with the help of machine learning to really find your way around this, okay? This may not only be inflation, as I said. Inflation is just one component. There may be other things as well. So it's really important that you have a very good portfolio management tool also on top of the risk modeling that you have run.
Understood, I think, to a level that I don't want to go any I'm not sure whether I could understand it to my grandmother. May she rest in peace. But I'll leave it at that. Cenk, I guess so. So what's your business model, right? Plus, what's your business model, and also how is your delivery model? Yeah, those two things.
Okay. The platform that I described, we have different modules within it, and every module has actually an animal name, kind of resembling what it does. It's, the risk pricing module, it's Cheetah, which runs risk modeling very fast in various algorithms. So we like that. Then there is this bee, which is preparing your data. So it's, hardworking data preparation side. Then there is this tool, Dolphin, which runs your scenario analytics, impact analysis, and then, talks to a pricing engine, taking prices all the way down to the street level, and also analyzing your portfolio as a BI tool on a day-to-day basis. I mean, the names are not that important, but basically there are modules. And depending on the maturity of the company, you can buy different modules from us, or you can use different modules. You don't need the full set of the pricing platform. You don't need to integrate into your core systems, but we recommend to do so because it works much seamless, obviously. So in our business model, you pay for what you use, okay? It's a SaaS business model. Different modules has different prices. Depending on how many modules you use, you will be paying for that module. And we don't charge on the basis of number of users. We don't care. You can have infinite number of users, but obviously we know in a company how many users there would be using actuarial tools. It's not like, using a Word or Excel eventually. And also, we don't charge for any license fees. So, you don't need to pay a bulk license fee to us. So it's easier on the cash flow side on the companies. And also you pay us monthly, but on an annual subscription. So it's kind of like a cell phone plan, if you think of it, okay? It's like a year committed monthly payment. And if you don't like the tool, you can always drop it. So, and we are kind of proud of what we do. So far, we haven't seen any companies dropping our tool. That also gives us a positive, urge to make always improvements on the tool and, put it in the market. So anyway, like this is how we work.
A rough range, because these are like power user, but is this, how do you get started? What's the kind of, can you give a range of how much people can spend, have to spend or can spend with you?
Okay, I mean, it's very simple. I mean, even I can put it on your laptop today, the modeling tools, and it would work, okay, as long as you have your data that is put it together. Mostly, some companies will have that, some companies won't. So it's instant, actually. The only thing that we help the companies and we really hold their hands in the initial stages is if it's a company that has never done modeling before and they don't have their data in a granular level, which is good for modeling or in a format good for modeling, then we go in and we make our hands dirty, really, and help them out with preparing the data, which is the very crucial part of modeling, because unless you have a proper data for modeling, you will not get good results or any result. So there, we run a bit of a project with the companies. But for the companies that are, that have their data together, it's instant. I can just put it in their server, I can put it in their native or in their cloud, and it will work just 5 minutes from now. I can put it in your computer and it will work. So it's very simple.
But you don't want to kind of share price ranges so people can kind of know around that.
It's a bit differentiated pricing for the size of the company and the maturity level. So I don't want to get people confused on that.
Fair enough. And it's, listen, I think it's more than fair. It's when people kind of ask me, my co-founder was saying, how long is a piece of string? You're like, yeah, fair question. How much does a car cost? And you're like, yeah, just roughly. Or how much does a house cost? Like, well, okay. I don't know, depends a little bit on the house or the car. It's not a commodity market.
We don't differentiate that much. We have a price for depending on the size of the company, but it's affordable. And for what it does, really, I mean, we'll get into that. We see many cases, we are able to improve the loss ratios by 3-4%, and that's a bottom line effect right away. So the price you pay for tools like this, you recover it instantly, and eventually, I mean, it's just a very minuscule part of what you're saving on the other hand by modeling and using these tools time-wise and also, revenue and bottom line-wise.
Have you, just out of interest, when you say 3 to 4% loss ratios, are these kind of, because how does it impact that you might over over increase your prices or over increase your underwriting? Because is it like 3 to 4% at the whilst keeping the existing churn the same, or how does that?
Of course.
Okay. Yeah.
I mean, you can opt for different things. That's the beauty of it. One, that maybe you are running for profitability and you are okay to see some more churn. Okay. So you can increase your prices for certain risk levels. So you'll get a better portfolio, a lower loss ratio, and a bit of a higher premium. So this is a profitability game. Or you want to keep your churn the same level, okay, or actually even lower it, and then go for a bit of a market share, but can still improve your portfolio's risk level, keeping these stable and the same. So at that point, you have many options. But let me just give you a couple of examples in the past that we have worked with. Good names, international carriers. One is for household insurance. Actually, household insurance, home insurance, we see that models work even better on the machine learning side, because when there is less data, traditional models and the way pricing things can be improved vastly with machine learning models. There, leaving the same loss ratio, for example, for same premium level, we have seen cases that we are able to improve the loss ratio by up to 5%, really. So this is really important. And this is just by the power of risk modeling. I'm not getting into the savings on the operational side by, analyzing the portfolio, taking decisions and putting it into strict level instantly. That is not very easy to measure. But this, what I'm talking about, is really hard measurement, because you can really measure your mathematical results. At the end of the day, this is math. It's not like what I think or what you think. That's on the household insurance. On Casco, motor own damage, we have seen in very good portfolios that we can improve the loss ratio by 2 to 3%, okay, by still keeping the same premium levels. So it just goes directly to the bottom line, you can imagine. So, I mean, for the cost and the benefit, it's really a good deal, that I can tell you.
Awesome. No, I mean, I think that's really interesting. Just out of interest, have you thought about kind of partnering up with, I don't know, price comparison websites, data providers around buildings insurance, other providers that have additional data, more kind of from the outside of what a normal insurer would, and to kind of even add that game that we can, kind of mix external data and internal data, and thus making the ML even more insightful, because this is not something that they've even considered in the past, and they might not even directly be able to access it, because it might be by providers who are working with multiple insurers, so they don't want to give the data, but might be willing to share the insight.
Okay, I mean, good question. First of all, that's a new and up-and-coming trend. Obviously, insurers have the insurance data, but as a person, your life is not only made up of insurance or insurance products at the end of the day. We all have a different life that we are living on a day-to-day basis. So it is very important to bring in external data, which is not non-insurance, surprisingly, non-insurance external data, and put it together with insurance data, which we call to get the 360 view of the customer, okay? Once you know more about myself, what do I do? Where do I live? What do I eat? Where do I entertain myself? I mean, what is my lifestyle? At what stage of life am I, okay? Without obviously going into the GDPR regulations and not so personal data. Once you get this 360 view, and which we do have a methodology, and actually we have a module putting this all together, but this data should be meaningful for insurance pricing, obviously, because that's the essence of what we are doing. So we get this non-insurance data about the people. We actually create personas, not to fall under the scrutiny of the data protection regulations. And there is no personal data, but we are able to define a person so well that, we don't need any more personalized data. As I said, we create personas, or you can say avatars in a way, okay? So when you couple this with the insurance data that the insurance company has, you get much better results on your risk pricing or determining your commercial pricing. You can actually, if it's allowed, take it all the way to personalized behavioral pricing. So today, think of it, as an insurance company, we are pricing the risk, the same risk, same price. But maybe I'm willing to pay more for a bit of a differentiated product or a differentiated risk in that product than you. We may have the same risk profile, you and me. Or you may be willing to pay less, okay? Which doesn't mean that I need to give you the exact same price for this product. So you can use this external data, one, to determine the better risk profile of the customer and define it. So you can actually identify customers in a much better way than what you're doing today. And it also has a community benefit that you are now pricing the better risk guys better, worse risk guys worse. So, everyone needs to get a better fair price. So you are actually, in a way, increasing the level of insurance capacity overall in the community. That's one. Secondly, on a commercial sense, you could actually improve your margins, or, as I said, give better pricing for certain segments, or even a worse pricing for certain segments, a higher pricing, and manage your portfolio in a much better way. So yes, the external data is very important, but to be able to put it into your models or your commercial pricing, you really need some technology and tools to be able to do that.
I have a question to your pricing. If this effect on your combined ratio is so obvious, why don't you switch? Why don't you switch it to no cure, no pay? I mean, you could just say, okay, you can use it, and because we're so convinced about it, you pay afterwards when we have proven a better combined ratio.
Which is fair, and we run sometimes models, and we do have a business proposition as such. That's why it's very hard for me to explain all the pricing. It depends on the company's appetite and what they want to do with this, but we are open for that kind of a deal because we are very confident that we can really improve the prices.
So you can also do it, let's say, for a kind of test, huh? And then say, okay, let's say first year, and then afterwards, if you have convinced your clients and you will use this in the long run, then it's only in the time of acquisition, which could perhaps scale your company much faster.
Tom, you're 100% right, and we run some POCs like that. Okay, we go in, we ask for their data, and sometimes we put the data together ourselves, and then we run a model, and then prove that it can work better, because at the end of the day, it's statistical, mathematical results of the algorithms. You can even see it before putting it into the street. I mean, if it predicts better, it predicts better. There is no discussion on that. So we are able to prove, and that's how we mostly gather our customers, at least in the early stages. Once they see it, they want to use it. So
and I think, I fully appreciate how that is something you kind of go by client basis, because at the end of the day, it's similar to, why don't strategy consultants go on their results? Because at the end of the day, there is a gap between insight from the modeling and actionability. So for example, they might say we have the great prices, and all of a sudden, but our Guidewire system, we cannot really update the prices for the next 3. It was really interesting. And then you're kind of stuck. Or they say, but we've already have these contractual relationships with all and we cannot, or, I think there's then even there's other things about getting the price to the customer that are then outside of, of the sphere of influence of Cenk and his team. And so I think you want to kind of make sure and ask these questions. So if we agree on this, do you then also enact, and how long does this take? Because otherwise, you're being hung out to dry.
I mean, 100% right. You know how it goes. Obviously, we cannot run the commercial side of things for the companies. We can only help them out with identifying risk, pricing it better, and give them the tools to do this, and give them the tools to get rid of all the excuses. For example, my core system cannot instantly price these changes. Okay, we do have a pricing engine. We can connect it to your core system, no matter what core system it is, and instantly you can now have this all modern way of pricing instantly. Okay, it's up to the company. But we get sometimes requests from companies, why don't you run our actuarial department and the commercial pricing? That's obviously we have the ability to do that, but that's not the business we are in. We are the technology provider. We are enabling them to do these things, and we case by case show them how to do it. We prove it that it can be done in a better way and can improve their results vastly. But at the end of the day, we cannot take the commercial decisions for them.
It's interesting though. I've talked to a team. I think they worked for some company of McKinsey, and what they've done is they would take success-based, a blend as well, and they would take bets on mispriced niches, and kind of go in and have that model. And I think at the end of the day, as with most, not every commercial relationship is the same, and there is an evaluation about managing risk and reward, and you'll kind of look at that, and part of it is also sphere of influence of what you can do, and how many dependencies you have. And so I appreciate that. For also personally, Tom, it's never good to go into a corporate with a POC if they don't have to pay anything, because that doesn't mean anything.
No, that doesn't work.
Because they're very easy on their time in a corporate, very easy, but on their budgets, they're much, much tighter. And it just doesn't mean anything if they're spending a lot of time and you're like, wow, they've invested like months of this, and you're like, I don't, that doesn't mean anything unless someone pays something. That means that someone now is responsible and has to support that against the other portfolios of alternatives, etc. So I would never do anything.
Yeah, in the early this is also an advice for any startup watching us. Probably, apart from the pricing people, we learned it as well, that what you're describing. In the early stages, we were willing to do some POCs at no cost. That doesn't work. The company has to also put some, resource, money, or responsibility into the thing. Anything that is for free, it does not have a value for anyone. So,
and I think I would not argue. I think kind of two things, because I don't know whether that is good advice to begin with, unless you already are super knowledgeable and can recuperate that price. Because, if that is the way to get references, etc., it might be a worthwhile investment. A lot of people have, but then you change your tact, right? I do things differently now than 8 years ago. But that's fine. I'm 8 years, and hopefully I'll do things very differently in 8 years' time. And I think that's fine. And I also don't mean that corporates are, leeching or stealing ideas. It just means the corporate decision-making process is very competitive. They have scarce resources. People need to apply for budgets. And unless you've gone through that portfolio steering, it doesn't mean anything. And a good leading indicator is someone to say, I'll assign budget to this. So if someone asks, I also need to explain. So that is a very good indicator. So it's not about bashing anyone. It's just a realization of how these conflicting priorities are being hashed out in a large corporation, or any larger group for that matter.
Yeah. Sure.
Kind of just conscious of time. What's the flip side? What are the biggest hurdles for you? What are the biggest constraints? Why do people not work with you?
I mean, insurance industries, we need to accept is a conservative one. So we need to really understand that, you know, people have been doing things for nearly decades the same way. Changing is not easy. And when we look at the insurance companies, there are some new ones, but mostly they are more than 100 years old when you look at it, the general theme. So change is inevitable, but sometimes there is resistance on the changing things the way that is being done today. That's one. Secondly, it could be a data problem. Most of the time, sometimes when it's a new company, they don't have enough data to run the models on. It's, you know, they may have different needs. They may not have the resources on the IT side to sometimes build data marts, or the data is not so clean or not available, even sometimes in old companies also, that, you know, they cannot really precise the model for risk. But to overcome all these obstacles, that's why we developed all these modules that can really take care of all these issues that we are kind of talking about. And as a company, we are not looking from outer space into the company and, you know, oh, we don't want to get our hands dirty. So it's a data issue, as I said, we'll go in and make sure we get that data properly. And then, you know, we get them up to speed on this data prep side. Once you have the data, it's pretty simple. That's kind of the place. Sometimes, if you want the things to work integrated with APIs, they may have some IT resource issues or prioritization. Okay, but at the end of the day, once you show the company this is at the heart of the thing, pricing, I mean, it's one of the most important processes.
The solid components of an insurance value chain. I would concur.
Exactly. Then things go a bit easier, and they need to also be convinced that integrating this is pretty easy also, which it is actually. So we built it in a way that the APIs can, you know, easily be built, and we have the APIs built in already. So it can connect to any core system and then kind of plug and play. So these would be the obstacles. One, conservatism. Secondly, IT resources or the data issues. So, I mean, mostly we see these.
Awesome. Was there anything that you felt we didn't give you a chance to educate our audience on before we call it a wrap?
I think we talked about all the aspects, and it was a good discussion in my view, and it was, I enjoyed it, every moment of it. So I think I cannot think of anything more that we can talk about at this point.
Tom, any last pun?
No last famous words. No, it was interesting to listen to your discussion, because I mean, it's I think it's pretty technical stuff, but I think it's still understandable for also for non-specialists. I mean, it should be so, because otherwise we can only talk to a very limited audience. That's right. But at the end of the day, pricing drives a lot of things on the insurance side, and everyone needs to know a bit of what's happening. Yeah, sure. No, thank you very much. Okay, thanks a lot.
Thank you so much for your time, Tom. As usual, a pleasure. And I wish you both a lovely day, and everyone listening have a nice day. And I'm sure that if any of these topics are of interest, that Cenk and his team will reply to any messages over LinkedIn, etc., and reach out to him. Take care, guys.
Of course. Thanks a lot.
Bye.